Welcome to the latest episode of the Aspire to Wealth YouTube channel. My name is David Ibarra. I am the founder and lead advisor of Aspire Wealth Planning LLC, where I provide fiduciary financial planning and advice, as well as investment management. If I could ask you to please take a moment to like, subscribe, or comment on any of my videos, I would really appreciate it. The topic of today's video is going to be interest rates. The Federal Reserve has already made a huge decision to cut interest rates by 0.5% and have signaled further reduction in interest rates throughout the rest of the year. But what does the Federal Reserve reducing interest rates mean for you specifically? Well, the first thing most people think about is the lower yield that they're probably going to start receiving on their checking and savings accounts. However, there are a whole slew of outcomes that happen when interest rates fall. But I'm going to cover two of the most important pros and two of the most important cons for consumers to expect to see from lower interest rate yields. Let's start with the pros. Lower interest rates mean a lower cost of capital, or essentially, it's cheaper to borrow money. Remember 3 years ago how fortunate people were to be able to finance brand new homes between 2.5% and 3%, while those same homes were being financed only 6 months ago at over 7%. Now, a 0.5% reduction in interest rates doesn't get us to where we want, but with every decrease in interest rates, it opens up the possibility for thousands of home buyers across the country. Pro number 2, higher market valuations. The additional economic activity that's driven by cheaper cash tends to spur the stock market. Investors also tend to move money out of things like bonds, which now have a lower yield because of lower interest rates, into more favorable investments like stocks. This rebalancing has historically increased stock prices overall. Now let's talk about some of the potential drawbacks for lower interest rates. Number one being the potential for higher inflation. The reason why the Federal Reserve had to be so careful in lowering interest rates is because they needed to be sure that they were not going to create an environment of higher inflation that we saw a few years ago. When you lower interest rates, that causes people to spend more money and borrow more money, which means that items that are already in demand could be in even higher demand, including homes. So where you may be thinking that this is a good opportunity for you to save on your home, you may find that the increased competition for purchasing homes leaves you with a higher price tag on the home itself. The other con could be creating an environment where people have a higher capacity for risk. So what we're seeing is going to be a shift in the market. And let's think about people in the later retirement stages. Suddenly, their money markets and bonds are no longer yielding the 3, 4, 5% that they were accustomed to. So maybe they feel that they need to shift some of their bonds into more risky investments like their stocks. The other thing is that it could create an environment of overconsumption where people now have the ability to borrow at a cheaper rate. This flow of capital moving into the economy could create unnecessary bubbles, or it could even hurt people's personal financial plans through the overconsumption. So what should I as a consumer do about falling interest rates? Number one is review your portfolio. If you have a large concentrated stock position, you should have a good understanding of how that stock and the sector that it lands in should perform given that interest rates are now falling. Or if you tend to be a more conservative investor that have a lot of bonds, or you're in the later stages of retirement, you should have a strategy in place for how you're going to make up for the loss in yield on your portfolio. Number two is that you should have a plan. If you plan to finance a large purchase, such as a home renovation, maybe a brand new car, or even purchasing a home itself, you should have a thorough understanding of what your debt capacity is, because there's two things that we don't want to happen. Number one, we don't want to sacrifice our ability to retire on time. And number two, we don't want to sacrifice the comfort of our day-to-day lifestyle by having too large of a debt payment. If you have questions about your specific financial plan or investment portfolio, please feel free to reach out as I'm happy to help. Once again, if you could take a moment to please like, comment, or subscribe. And thank you so much for tuning in. I'll see you next week.